22 years of experience in the Indian equity markets. He manages funds such as Religare Invesco Tax Plan and Religare Invesco PSU Equity Fund, both of which have given returns of over 50% in the last year. The biggest outperformer, though, has been the Religare Contra Fund with returns of 74% in the past year. Which are the sectors and stocks, therefore, to invest in? Well, today our alpha manager is Vetri Subramaniam, Religare Invesco Mutual Fund. Vetri, thank you so much for joining us. And let me start by asking you not just about today's market action or the talk of, a correction that was underway which may have ended, but more a sense of where we are in this bull run, according to you.
Well, I think where we are is that, we've gone from a market which was very, very pessimistic about a year ago to a market which transitioned to what I would call the hope trade in the first half of the year leading up, let's say, to May 2014. And post the election verdict, I think the market's starting to get a little bit more selective and it's starting to think about where actually the visibility is in terms of earnings growth. So there's been a significant amount of transition over the last 1 year. I think as far as the economy is concerned, the good news is that there are signs that there's a mild recovery underway. But at this point, it's still very mild. And I think in terms of seeing significant government-led policy action which can give the economy more traction, I think we're yet to really see much of that. And hopefully we will see that over the next few months.
Well, how much of that has already been priced in, Vetri? How much of that hope that there will be government action and reform has already been priced in, and so will the government have to do a hell of a lot to meet these price expectations?
Yeah, so I mean, there's a simple way to look at that, Senthil. If you just look at, the market, which is up about 40% over the last 1 year, if you actually look at how much earnings are up during this period, earnings are actually up only about 14-15%. So what you can conclude from that is that the rest of the gains are essentially the change in the PE multiple, and essentially that in some senses reflects the change and the optimism that future earnings growth for the market will be significantly stronger. So I think a significant portion of the sort of multiple re-rating has already taken place, and I sort of think of this as the phase in which the market is saying, show me the earnings and I want to see that earnings visibility. So I think some of that re-rating has taken place, very specifically, and I think the best example of the extent to which the re-rating has taken place is actually the capital goods sector. If you go back a year ago, it was trading in the low teens in terms of its PE multiples, pretty much among the cheapest sectors in the market. And if you look at it today, it's trading at a PE multiple of more than 30, and it's among the 3 costliest sectors in the market. So there has been a significant re-rating within the market, and you need to, take cognizance of that.
I want to talk to you about one of your funds that has been the biggest outperformer amongst the several that have been outperformers. And I'm going to use this to try and get into your head and try and understand how you've sort of positioned yourself over the last 12, 18 months and, what your strategy will be from here onwards. So the Contra Fund, I think, did 74% in terms of returns over the last 1 year versus a benchmark performance of 38.5%. Talk us through really how you strategized or, managed to achieve that and how you're positioned here on that Contra Fund.
Right. The Contra Fund, to put it simply, has got a very strong value approach in the way that it goes about identifying companies and businesses. And it's also very early to take on risk, because if we are able to perceive valuations as being attractive enough, we don't wait for the accompanying sound bites of, an improvement in growth outlook or earnings growth numbers to really start getting invested. So we're always early to take on risk in that portfolio. And, if I look at that portfolio, honestly, it gave us a lot of grief in the first half of calendar 2013 because even after we started finding a lot of the economy sensitive sectors of the market cheap, many of those sectors actually got battered and bruised all the way up to about August of 2013. And really, when you look at the strong outperformance that's come after that, it's really been a function of the fact that we held on to most of those positions because we had the conviction that valuations were on our side, and we did see some cyclical bounce playing out into 2014, but at the point where we built these positions, we had no clue about who might even contest the elections, leave alone that the market would perceive Narendra Modi as being a very pro-growth prime minister. So these positions were built much in advance of these news flows, simply because the valuations were supportive. And I think in one word that describes our approach in that fund. We're always very valuation conscious in terms of where we want to allocate our money into and which stocks that we are willing to buy. Once we've done that, we're happy to let those stocks run. We're happy to let those stocks run up as businesses do well, but we are very, very careful about where we deploy that money and what stocks and what valuations we buy them at.
Okay, so on the screen we have a graphic plate that sort of depicts the top holdings in that particular fund. How many of these stocks have run out of breath, Vetri, though you're happy to watch them run for the last 12 months? Tech Mahindra, Maruti, HDFC Bank, Britannia, Bharat Forge, Wipro, which has not necessarily had a great year to date, Federal Bank, DB Corp, Gateway District Parks and ONGC.
Well, I think some of them have run up quite a bit and they're not really adding to them anymore. But if you look at a name like HDFC Bank, it didn't figure in the portfolio last year. It's something that we added because it saw a significant amount of underperformance sometime earlier this year. We've also added some of the names like DB Corp, MRF. Those are portfolio names that we've added to. And some of those other names have just sort of risen to that top end of the portfolio because we've nursed those positions for 2 years or 3 years or more. Tech Mahindra, for example, is a classic case. We've held that stock for more than 3 years now, and we've just been happy to participate in the run-up as the company has executed well. So the portfolio is always a mix of sort of names that we're looking to buy into, as well as other names that we may have bought earlier, and then now we're just happy to ride, the good performance those companies are bringing home today.
You mentioned Tech Mahindra, HCL Tech, as well as Wipro, I'm told, are amongst your top holdings across the schemes that you manage, Vetri. What do you make of the performance that some of these stocks have had besides Tech Mahindra, which you've already spoken of? HCL Tech, I think year to date, that's up 33%. Wipro is up barely 4 or 5% year to date, if I remember correctly. TCS, and then, of course, Infosys.
We still think tech in general is well positioned. They've got fairly reasonable revenue traction growing in sort of the mid-teens numbers, so we think that's healthy. The US market, which is their key market, appears to be on reasonably even keel. I think overall it's a fairly nice scenario for them. They don't have the kind of currency buoyancy that they had last year, which really underwrote their earnings growth. But the currency we think will continue to stay on a mild sort of depreciating trend, which over time will anyway benefit them. But anyway, currency is not really the key reason which we think drives these companies. Is really the revenue growth, and at the mid-teens levels we find valuations in tech quite reasonable at this point of time. So that's an area that we are quite happy to own in many of our portfolios. The names itself might differ. I mean, since you asked me this question, one reason why we never owned TCS in the Contra fund is that stock has traded at a huge premium to the rest of the sector for the longest time, so it never made it through our filters into the Contra fund, though if I do recollect, we did own it way back in 2009. So there will be a difference in the kind of names that we own across the funds, but in the Contra fund it typically tends to be allocated to names where we think the valuation comfort is much higher.
No, yes, I get why TCS is not in your Contra fund. It's not amongst your top tech holdings across the funds that you manage. That's what the data I have says. So I was just curious to know how you're positioned in tech. You've already given us an answer to that, but are you adding more money to your tech positions, for instance, Tech Mahindra or HCL Tech or Wipro at this point in time?
Not yet. They've had huge outperformance over the last 3-4 months, but we did add quite a bit in May, June, when it was coming down quite sharply because people were worried about the outlook for tech and money was rotating into economy sensitives, and there was a lot of talk of the rupee going to 54 and 55. So we thought that was a good opportunity to add to tech. Right now we're not really adding very significantly to those positions.
Again, based on the data I have, Vetri, it doesn't seem that you're very bullish on pharma because top holdings across the schemes that you manage don't seem to feature a pharma stock, if I can see that. Yeah, no pharma stock from the top holdings. In financials, those top holdings include HDFC and HDFC Bank. In auto, they include Maruti and Hero Motors. In tech, they include HCL Tech and Wipro. I can't spot a pharma name. Correct me if I'm wrong.
No, you're absolutely right, Menaka. We don't really have any of the pharma names right at the top of our portfolios. We do own it and we are overweight in some of our portfolios, but typically we've always followed an approach in pharma of buying a bouquet of companies. So whatever exposure we have is always spread across 3-4 names. And to us, pharma has always been a very bottom-up sector because the distinction and the differences in business model between these companies is very, very acute. So, we've never favored taking a strong top-down call in pharma. It's always been about finding a bouquet of companies that we are comfortable owning to try and reduce the risk of major things that could go wrong. And what could go wrong in pharma, we've seen several examples of companies run into problems with the FDA, lose key molecules, run into problems on litigation. So it's always been a bouquet approach and we've never concentrated ourselves in just one name.
So what's the best selling flower in that bouquet, Vetri? What's the best selling flower in that bouquet?
I think Lupin would pretty much be among the top names if you looked across the portfolios, followed most probably by Sun Pharma, and among the younger names it would be Biocon and Ipca.
Biocon and Ipca, okay.
But is this propensity to go for a bouquet in pharma, is it only because of regulatory issues, or is it also because you're not very comfortable with management qualities?
No, I think it's just got to do with the intricacies of the business models, that they're very difficult to understand, and each company has very distinct sort of elements in terms of the geographies in which they operate and the kind of reliance that they have either on specific product lines or products, or for that matter specific plants in terms of where they generate their revenue from. So we've just always felt more comfortable with that kind of a diversified approach rather than just betting on one or two names, which is very different, for example, from the way we have our financial exposure, where in financials we actually have preferred to back only those names that we feel very strongly about, and therefore in financials you'll see that maybe 3 or 4 names will account for 70-80% of the exposure in many of our portfolios, and this despite the fact that financials as a part of the market is actually the single largest part of the market. So we're happy being concentrated in areas where we have the conviction and we have an understanding of the business model that gives us the comfort, but on the other hand, in a smaller part of the market, which is pharmaceuticals, where we don't get that kind of comfort, we tend to make it a bouquet approach. So it's a question of what's right for each sector which really works, rather than just a one-size-fits-all approach.
It's been an interesting couple of months, right? We've seen sort of all the capital goods frenzy, the infrastructure frenzy that took place prior to the elections and just right after the results sort of ebb off a bit. We've seen defensives come into favor over the last couple of weeks or so. How are you positioning, or what do you expect will be the sectoral allocation here onwards? What will do better than the rest?
Okay, if I just put it in the context of my portfolios, I think, the area that we were hugely positive about a year ago, which was industrials, because we thought valuations were very, very cheap. That's not the case anymore. So largely we've either reduced industrial exposure or gone to underweight in some cases. And the area where we've increased exposure very dramatically has been more in the consumer discretionary space, which is, auto, white goods, media, that sort of stuff. And incrementally in financials is the other place where we've added weightage, simply because we think these two will respond to any improvement in the economy much quicker in their P&L account as compared to industrials, where I think a revival in the investment cycle appears to be a prolonged effort. And also simply because I don't think government policy at this point is really bringing that urgency to the table in terms of kicking off the investment cycle. So, everything put together, valuations plus the context, that's the way the portfolios are currently positioned.
All right, Vetri, stay with us. We're going to take a quick break. We've already discussed several large cap stocks and sectors with Vetri. When we come back, we'll try and get his views on several mid-cap stocks, the favorites amongst the schemes that he manages. That's up next.